For Bharat to truly rise, access to credit must go beyond the metros and reach entrepreneurs, as Sir also mentioned in his very special address. It has to reach more entrepreneurs, MSMEs, and communities that are building the new India. Our first panel today is titled How Banks Can Boost Lending and Build Bharat. And we will explore how India's banks can now reimagine lending, not just as a financial service, but also as a tool for nation building. To moderate this session, I'd like to invite CNBC-TV18's Latha Venkatesh. And joining her are her panelists, Ashok Chandra, MD and CEO, PNB, Mr. Ram Mohan Rao, Amara, MD, SBI, Rajiv Anand, MD and CEO, IndusInd Bank, V S Manian, MD and CEO, Federal Bank, Rajneesh Karnatak, MD and CEO, Bank of India, and Dr. Debadatta, MD and CEO, Bank of Baroda. Ladies and gentlemen, could we have packed a more powerful panel for you? A big round of applause for the most sought-for men from the banking industry who have given us their time. Thank you so much. Over to you, Latha.
Thank you. Well, I think we have about 200 trillion rupees sitting on the dais, almost the entire banking sector over here. 1/3 is on my right, and then if we add up the others, we are almost covering the banking system. Maybe 20% short or 25% short. Well, the topic given to us, AI-powered and credit-driven. So let me start with credit, though of course to get the credit going, we need the deposits as well. But the first questions really are on credit. The Reserve Bank has flooded the system with liquidity. But are you finding enough borrowers, Mr. Rao?
I think maybe your concern may be stemming from the fact that Q1, the credit growth has been tapered. And
it is less than 10%, sir, and now deposit growth has crossed credit growth.
I think I will dwell on one or two factors as to what led to such slow growth before I dwell on like what is looking like. In the sense, like particularly if you look at the segment like corporate, it grew hardly by 6%, right? And there are reasons for that. Generally, seasonality is one factor. Second factor is they were able to access debt markets through the CPs and through the bonds, etc., at a very, very competitive rate. And my team tells me like this is not the first time this happened. Earlier also, whenever the rate cycle was reversing, I think corporates were looking for that opportunity to tap. But in Q2, what we have seen is like a particularly post-MPC, we have seen some hardening of yields also. So we have seen the volumes in Q2 actually coming down. CP volumes have come down. Bond issuances have relatively come down. And including even the CD issuances from the banks has also come down. That also shows like there is not that kind of pressure on the deposits kind. But looking at H2, like what is that in store for us, we are very optimistic. While there is this uncertainty or the cloud hanging around the tariffs, etc., I think the GST2 reforms are very, very timely. And the monsoon is favorable so far. And the tax cuts are yet to play out, whatever were extended in the budget. So we are very optimistic that this is going to lead to something like a virtuous cycle, which will create the demand, which is placing more disposable income in the people's hands, which will lead to investment, which is private capex. I think with that concern was always that
corporates to come and take money.
We are expecting because they need to see the demand. Obviously, I think they're adopting a wait and watch. That is what my assumption is. So once they see this demand reviving, particularly the festive season augurs well, I think even anecdotal inquiries are very much a number of inquiries are there.
Will you do your guidance of 13%?
I think based on these facts, I mean, see, while the Q1 might have put a color around the 12-13%, but I think for the factors I mentioned, like whether it's a GST or whether it is a monsoon, etc., we are very optimistic that 12-13% growth is still achievable. But of course, subject to the fact that actually tariff is going to be resolved, if not in a month, at least in 2 months kind of time. There is expectation. If it is not, then obviously 1 or 2 percentage points it can.
Okay.
Come.
Well, let me get someone from the private sector on the same issue. What's your sense, Mr. Manian? I actually heard a private sector bank telling me, Reserve Bank has given us all this money. Kisko do? Was this question. I mean, not all retail, I mean, he was referring to retail, are ticking all the boxes that I have for due diligence.
You know, Latha, I think we are going through some volatility, right? The expectations on the GST has held back some demand, consumer demand. So tariffs are causing some uncertainty. My feeling is that as we progress through the next quarter, I think some of these uncertainties will clear. And hopefully 22nd September is a D-Day, and then we know that car sales are held up, they are booked but not sold, right? And that is happening across products. So one is hoping that we are going to see a turnaround post 22nd September on consumer side demand, and usually consumer side demand should lead to consumer credit demand as a follow-up. So we are optimistic about it.
Okay, well, let me just take one round of rapid fire from all of you. Give me your number, your credit growth number. Mr. Chand.
We said earlier 13 to 15%. I'll stick to it.
Sorry, once again, sir.
13 to 15%.
13 to 15?
Yeah.
Oh, that's excellent. Rajiv? For the industry and for IndusInd, if you can.
I think industry should be 11 to 12%. I think if we can get there, we should be happy.
You would do that?
No, that's for the industry at the moment.
Yeah. You don't want to give a number for yourself?
No, not yet.
Not yet. Mr. Karnatak?
Yeah, with GDP pegged at, say, for FY26 at around 6.5%, traditionally the credit growth is double of that. So I would say 12 to 13% on a safe side.
So all of you are within that 12 to 15. Mr. Chand is more optimistic.
I think, as I said, we stick to the guidance, whatever you said. Still optimistic.
Okay. Mr. Chandra?
Yeah, 11 to 12% I will be expecting, and there is enough room to substantiate that figure also. I will discuss in detail about it.
Okay, 11 to 12 is the full year average or exit number?
No, that will be the full year YOY average, what we call
then
about
your
it.
second half is almost what Chand is saying.
Yeah.
Same, I am also in the 11 to 12%.
For the full year. Yes. Okay, that's better than at least we are reaching double digits. For a nominal GDP of 8.8, I think 12 is still very positive. But then, is the deposit war over, Mr. Chand?
So look, when we said the growth would be, because the RAM segment is going very strong. If you look at my number for June, the RAM means retail, agri and MSME, it was the growth of almost 16% therein. So I think going forward, typically we are at Q1, Q2 yet to announce. And Q3 and Q4 are the busy season, right? So both on the deposit side, advances side, a lot of uptake would happen. So in scenario like that, I'm quite optimistic that even if the deposit growth is low, but there is a system liquidity going to be very strong. In that way, mobilizing money is not a challenge at all. And in the same sense, funding the asset out of the liability, I'm not thinking of any challenge going forward.
Okay. Funding the asset out of the liability. That is the real problem, Mr. Chandra. Because yesterday we had that data coming out of the CRISIL analysis. They are saying that household share in deposits has come down from 64 to 60, which means it is getting replaced by institutional credit, which by its very nature is volatile. So do you think that banks are increasingly going to become retail lenders also? Because your liability is becoming volatile. Will you all stop or at least sizably reduce long-term lending, infra lending?
No, I don't subscribe to that logic at all. See, all the public sector bank, and in fact in broader sense all the banks, our goal is not only to restrict our lending to the retail or agri. In fact, we are doing a lot of infra lending, and as on today also, we have a good pipeline of infra lending. We have a good sanction book for the various infra lending, long-term lending, so and all. So I don't see that we are going to restrict it to the retail segment only. Yeah.
No, I agree with you that this far, you still have 60% of households, and therefore some term deposits are stable. But if this trend continues, in just about 3 years, the share of household has come down. So is it likely that going forward, banks will move out because of the ALM mismatch, not because you don't want to lend to infra, but you don't have long-term lending?
No, that is not the case. In fact, see, what has happened, some diversion of the fund has happened from the household saving in the bank. It has moved to the mutual fund and the stock market. And see, this is the process. When the country is moving from the developing to the developed nation, that is the gradual, the shift has to happen, and that is happening. but it doesn't give me a room to understand that, yes, the lending also has to happen only to the retail segment. No, it doesn't happen like that, yeah. See, we are getting, there is a drop in the CASA. Yes, right, the fund has gone to the mutual fund. But we have a good retail term deposit base is there, having so much presence across the country. So we have good retail term deposit, which we are getting it replaced by way of the CASA now. So overall deposit, I think we don't see any challenge. And when the liquidity is there in the system, I think deposit growth is happening at the speed of around 11 to 12%
deposit growth
now.
is happening.
Yeah.
I'm only,
so when you have the deposit, and when you have the opportunity to go to the market to find out any good project and all, I think we are all ready, and the public sector bank is the player who is dominating in the infra field.
Okay. The longevity of your deposits is what I'm worrying, not quantum. Quantum will definitely rise, but
can I supplement actually? Yeah. I think when you look at the greenfield project, particularly in a sunrise sectors, etc., I don't think they will be straight away in a position to access bond market or anything. So the banks will have to take care of the infra. But what's happening is once they achieve the COD, once they achieve the stability, then there are a lot of takers for funding them, right? And eventually, of course, we will also reach a kind of maturity where the resource requirements of large corporates or infra are going to be met through a combination of bank loans, corporate bonds and equity. I think that's still a far away. I'm not saying it is going to happen in a day or two, but eventually we'll be moving towards that direction. But the role of banks is very much there, particularly the large banks, which have traditionally been underwriting the infra loans like SBI and others. I think I don't envisage any diminishing role for banks in infra funding.
There was a corporate who told me that my first source of funds is PLI. After PLI, I go to equity market. Then I go to bond market, and then I go to the banks. But obviously, this was someone who is in the PLI category. But Mr. Karnatak, a similar question to you. Where is the credit demand coming from? Are you looking at long-term loans at all, or are you going to stick to, say, MSMEs and shorter-term credit?
So just to build up on your previous question, Lataji, just wanted to supplement what was said. So CASA ratio, if you see, it is at around, for the scheduled commercial banks, at around 37-38%. Right? There is a challenge in CASA, as rightly said by my previous speakers also. There is a shift which is happening in the household savings, as you said rightly. But see, the color of money is changing. Like when the money is going outside the banking system from CASA to say mutual funds, to pension funds and to the insurance company, this is coming back to the banking system from these three players,
Yes.
right? Once it is coming back to the players, so there is no challenge as far as the deposit is concerned. If you see the latest RBI data, which is of 23rd of August, for the scheduled commercial banks, the credit growth is at around 10.22% and the advances growth, the deposit growth is at 10.22% and the credit growth is 10.03%. So there is a delta of 19 basis point now. This is against the data which was there in March 25. In March 25, the credit growth was 11.3% and the deposit growth was 10.2%. Okay. So the things are changing now. As regards where we are giving for, see, we see a lot of credit growth happening in the RAM sector, particularly retail, MSME and agriculture. If you see for all the banks, again the RBI data, there the credit growth on a YOY basis as on June was more than 15%. Yes, I agree that in the corporate segment, the credit growth on a YOY basis is in single digit. It's not even 10%. So that is where the challenge is. If we are able to pick up that credit growth in the corporate sector, definitely the credit growth would be even higher for the financial year 26.
Okay. Well, there is another problem which bankers are speaking about in terms of deposits. I'll come back to credit. And that is mule accounts. I mean, is this a huge issue? While at one point in time, maybe not too long ago, banks were rushing to collect deposits even digitally. Now there is a scare, Rajiv.
So I just want to add to the previous question as well. I think not now, but always, almost all the deposits that banks get is up to 1 year.
Yes.
But one has to look at it from a behavioral perspective. CASA typically behaviorally stays what is core CASA for something like 5 to 6 years. And that is what gives us comfort. And of course, you have capital. The second is, as we think about long-term loans, particularly to infra, contractually, these loans are anything between 15 to 20 years.
Yes.
But behaviorally, once again, we have seen that most of these loans get refinanced in between 5 to 7 years. Very similar to what happens to retail mortgages. While the mortgage loan itself is 15 years, we've seen that behaviorally, they get repaid in 7 to 8 years.
If the infra companies come, bankers are willing.
Absolutely.
And able.
But where are they? I mean, I think the question to ask is, where are the people asking for, bank loans? But to the question on Mule, absolutely. I think it's become a big issue, for banks. It's become a big issue for, for the government as well. And let me just give you an example of how innovative, scamsters are. We've seen instances where a salary account has been opened of, let us say, TCS. The salary has come to that account for 6 to 8 months. The bank thinks that, yes, this is a salaried customer of TCS. It pre-approves a personal loan, and then you find that the whole structure that was built is all wrong, is all fraud.
False. Fraud.
And so therefore, that is the kind of innovative ingenuity that you're dealing with as far as scamsters are concerned. And so therefore, this is an industry issue. We work very closely as an industry. We work very closely with the Ministry of Home Affairs. They track where the mule accounts are on a bank-to-bank basis. Ultimately, we have to use technology to be able to deal with this. But the point that you make is very, very valid. Because what is also important to us is if customers get phished or whatever, ultimately we're in the business of trust. And if customers lose trust, then all banks, not just the individual bank, has a problem.
Okay. Mr. Chand, would you want to add to that? Or is it that public sector banks have more branches and therefore e-KYC kind of accounts are fewer? Or is it that all of you face the same problem of fraudulent accounts?
Look, the issue remains with all the banks on the same manner, right? And mule account is an issue for the banking system. And let me also say that when banks do open mule account, not necessarily these are not KYC compliant, these are KYC compliant account. Okay. Only a later part of the time then they rent it out or these accounts have been used for a mule purpose. Having said so, now if you look at the entire ecosystem, there is a great deal of coordination between I4C, the regulator, the banks, everybody trying to address the issue. At the same time, recently there was also an announcement of forming a new company, DPIP, just to address the issue of mule account.
Yes.
So the issue is known, the issue is being addressed. But then it's not that because of mule account, bank would go slow on deposit, bank would go strong on deposit, opening more and more accounts, bringing inclusivity into the entire banking. But let me again say it's more of an awareness that can prevent the mule account being misused. And that is what, again, all the banks, including stakeholders, we are trying for that.
Okay. Well, ICICI, for instance, I mean, I can tell you the name, when they raised the minimum balance to 50 and then withdrew it, their fear was this, that maybe we can avoid mule accounts if we raise the minimum balance. But Mr. Chandra, on that, first of all, is it increasing cost? Because, you have to use more technology per account. And secondly, is this a call, as Sohini was telling us from NPCIL before we came in, that is this an instance of interbank cooperation so that you are able to weed out mule accounts?
Yeah, first of all, it has...
cost.
It is there, it is there. And it has nothing to do with the minimum balance per se. The people can open that account with 50,000 average balance also. And it can be rented because mule account concept, what Mr. Chand was also mentioning, it is a full KYC account. There is no issue of the KYC or the due diligence in that particular thing. It is basically the renting of that valid account is being rented out and it is being misutilized now. So how you can handle it? Now almost all the banks, including my bank also, we have come out with different models in my EFRM, that enterprise fraud risk management system, where we are building the different scenarios. Yes, the costs are there now because for each and every transaction, now the different models, risk categorization is happening. And we have created the different scenarios in each and every transactions now. Each and every account which is getting opened, we are fixing the limit of transaction which is going to happen in that particular account on a monthly basis or quarterly basis. And based on that limit, if it gets 80%, if it gets crossed, then the SMS flows to the customer that you have crossed this trigger point. When it comes to 100%, then we are blocking all the alternate delivery channel in that particular account and the person has to go to the branch. So these are all these problems and the cost has happened because the numbers are increasing now. And in the system, banking system level also, the I4C is there, and now NPCI is also come out with a different model now. Each and every, the transaction which is happening in NPCI, they are giving a score for the transaction now. But all these things are indirectly, it is the cost is involved in that, because that much IT integration, digital integration, AI has to be there now. So when they are mapping and giving the score for each and every transaction, and then they are categorizing the transaction in the high risk, low risk, medium risk. And they had asked the banks to get integrated. We have integrated directly with the NPCI. And if the account is categorized, the transaction is categorized as the high risk, then it flows in my system, and it is mapped with the mobile number. If that person is having the same mobile number, and then with the mobile number, we search the account number in the system, and then that account gets triggered in my system also. And it is flagged out that, yes, something is happening in this account. We are not blocking the particular transaction,
but you are watching
yes,
it.
Alert gets generated.
Fair enough.
So all these things, it has happened because of the large volume of the mule accounts are happening in the system.
Yeah,
so it involves cost, it involves a lot of IT infrastructure also. So no doubt, I think it is at the cost now.
With that, that brings me to the next round of rapid fire. The first is a very easy question, actually. Will the Reserve Bank cut rates in October or one more? Manian?
Not in this round. I think not just yet.
But one more cut?
Maybe one more cut, but not just yet.
Not in October. Not on October 1st. Mr. Chandra?
Yeah, I'm also expecting that one cut will happen in the full financial year. I am also feeling
October?
that not immediately.
Not immediately. Mr. Rao?
I think it depends upon whether the full benefit of GST2 is passed on, because my economist says 114 basis points.
Rapid fire. So
it may happen.
Is there a
Timing
cut?
is
And
timing.
is it in
I am not
October?
sure, but it can happen.
Okay.
It can happen.
Yeah, chances of a cut.
Yeah.
Mr. Karnatak?
So 100 basis point repo has already been cut. So I don't foresee any cut in the
No more cuts.
in
Zero.
October. Yeah,
Not in October.
not in October.
Okay. Rajiv?
Certainly not in October.
Okay.
There could be another 25 basis points in the rest of the year, but I'm very certain that October we won't get one.
Okay. Mr. Chand?
Yeah, not to predict, but to anticipate, not this time, next time possibly.
Okay. So this is what, you also said no, Manian. So 5:1. No cut.
May happen.
Okay, so
Timing-
6-0. No cut.
Timing wise, I'm not sure. That's what I said.
Fine. Therefore, I wanted to come to margins. Since most of you are anticipating one more cut, how much more can margins get shaved off, Manian? In basis points.
From the sector's perspective, I think the last rate cut will get transmitted through this quarter.
No,
right?
just give me a number. How many basis points can margins fall for the
If you broadly
bank?
take, most banks have 50% of their assets, I'm taking a broad number, 50% of their assets as repo-based assets, repo-linked assets. So the impact has to be 25 bips for a 50 bip cut, right? But some of that would have come in last quarter, so I would say as a sector, 15.
Okay, I just want a number, sir. How much more can margins dip? One number.
See, Q1, whatever the NIM was there, I think more or less we will be maintaining the same in the
Maintaining
Q2
that.
also.
No
Yes.
more a dip in margins.
No. We have taken some corrective actions.
I think I can't put a number, but it will get normalized over a period of time.
No, I
think
know. I'm just asking. Okay. Any more dips, margins?
So it will get normalized in the Q3, frankly speaking. And traditionally, what we have seen, a 25 basis cut in the repo will reduce the NIM by around 10 basis points.
Okay.
I think you will see NIMs coming off in this quarter as the impact of the 50 basis points cut that we've seen the last cut. But I think, from Q3 onwards, you will actually see NIMs going up as the full impact starts to play out on the liabilities side.
We had a good NIM for Q1, actually at 2.98, right? So we still expect some bit of pressure in Q2.
Okay.
But Q3, Q4, there would be a significant pullback happening on that.
Fair enough. Okay, I have to call it a day because the finance secretary, the Department of Financial Services secretary is ready for us for his conversation. I'll just ask one more question of you. Mr. Rao, do you fear an MSME problem of bad loans?
No,
Because
not at all. Not
in
at
the
all.
first quarter, we saw some of the banks really give loans hand over fist to MSMEs, and the NBFCs, many of them reported bad loans. So do you think that is the next area to watch?
No, at least for us, for my bank, I can say, because very significant amount of underwriting we are doing through the digital means, particularly using AI. We call it a business rule engine. Just to share a number, I think during the last 15 months, I think we have underwritten more than 200,000 loans worth around 70,000 crores. And when we looked at the vintage delinquencies, they are exactly within the range what we anticipated. So my overall NPAs or SMEs are very range bound. At least in my portfolio, I am not seeing any stress buildup.
Okay. I would have loved to do a rapid fire on that, but we're out of time. Gentlemen, thank you very much. The big takeaway is they are not expecting a rate cut on October 1st. Thank you very much.
Thank you. Thank you very much.
A louder round of applause.